Hello and welcome to the Investing Channel. I'm Charlie Gibson and head of mining research at Edison Investment Research. Those regular viewers and listeners of the channel will know that I'm something of a fan of the yellow metal. And I just wanted to bring you up to date with an analysis I've done relatively recently that just puts recent moves in context. And of course, we all know about the coronavirus epidemic. We all know about the stimulus that has been applied. Markets are quite strong at the moment. And there's this sense that we're moving on to a risk-on situation. When I say markets, I'm talking about equity markets, and therefore there's a slight headwind, if you like, developing against gold. The suggestion being that it is, of course, a risk-off asset. And this is why I think that particular strain of thinking is wrong, certainly to the extent that it might suggest that the gold price should go down. We know, of course, about, as I say, the coronavirus, but let me just put the size of the stimulus in context. Before the global financial crisis, the US total monetary base, and that's the thing that I measure the gold price against, was about 800 billion US dollars. We used to talk about billions in those days. Then, over the course of QE1, QE2, QE3, all to deal with the global financial crisis, that increased from 800 billion to 3.9 trillion. So a pretty substantial increase of 3.1 effectively trillion US dollars. Now, they then had a taper. That took the monetary base from 3.9 down to 3.2. That was by the middle of last year. But in the last 3 months, the coronavirus stimulus, it has gone from 3.2 to 5.1. So it's gone up almost 2 trillion US dollars. That is effectively the same as QE1 and QE2 or QE2 and QE3. You can take your pick. Point is, it's a very big number indeed. And if you look at why is all this relevant, well, there has been since 1968 an astonishingly strong correlation between the US monetary base and the gold price. And that, when I say astonishingly strong, that is of the order of 0.9 if you were to use a Pearson product moment coefficient, the standard correlation coefficient that everybody uses. So there's way less than a 5% chance that this correlation happened by chance. And if you take that 5.1 trillion and you just say, well, what does that mean for the gold price? Well, what that means is a gold price of 1,892 easily. And then if you put a bit of speculative excitement behind it, well, you can easily get to over $2,000 an ounce, and with a lot of speculation, you could get to 3. But the point is, 3 is, it's not my central forecast, but it's within the realms of possibility, probably for the first time ever in history. And that's what we're looking at in terms of size. Now, there's still a couple of jokers in the pack as far as the coronavirus is concerned. There are also, of course, those other risk elements which are coming in. Now, you'll all be fully aware of what's going on with in the aftermath of George Floyd in the United States. You'll have also seen the prospect of US-China tensions rising over Hong Kong. I think it's fair to say they have risen. To what extent and what the consequences of that may be, of course, very difficult to tell. But I think we can safely say that they have risen. Now, if you think that you've missed the boat and you're thinking, well, how can, apart from gold metal, how can I take advantage of this? The one group of companies that haven't really moved, we've seen 2 groups of companies move quite strongly, and the main one is the producers. The medium-sized producers have taken full advantage of the rise in the gold price. The group that hasn't have been the pre-production explorers, the small caps, and their share prices are effectively where they were 6 months to a year ago. They almost haven't moved. Now, these can move very substantially. If you look at Free Gold Ventures, their share price up from 8 or 9 cents to 50 cents just in the last few weeks. We would expect those to catch up over the course of the next 2.5 years. So that just as they were last time round, this time round, they also being, when I say last time round, I mean the global financial crisis, they were the slowest to pick up on the rise in the gold price, but they did pick up with a period of outperformance over 2.5 to 5.5 years. So I would point you towards those. Also, you can expect a lot more merger activity in the sector as we go forward. That's all from me, Charlie Gibson. We'll be bringing you more such investment opportunities in the very near future, we hope. But until then, you have a very capital day.